Okay, the next concept we're going to talk about is called absorption costing. And we're talking about all manufacturing costs or manufacturing related costs, fixed and variable, are absorbed into the cost of the product. So from a definitional perspective, absorption costing means all manufacturing costs, both fixed and variable, are absorbed into the cost of the product. Okay. That means direct materials, direct labor, and MOH, which is manufacturing overhead, are treated as product costs. Well, you know, that's nothing new. This is the way we've kind of managed from the get-go. This is how we've managed our direct materials, direct labor, and manufacturing overhead from the get-go have been treated as product costs. So that's nothing really new. But what we also want to know, or what's pointed out in the textbook, that absorption costing is required by GAAP and the IRS. So for tax purposes, both of these are a full absorption costing is what we're going to be using. Now the new concept that we're going to be looking at is what's called variable costing. And in this case, only variable manufacturing costs are treated, only variable manufacturing costs are treated as product costs. That's something different. We haven't been using that, but you know, we're learning about variable and fixed costs, so that's why we're doing that, because that makes most sense, right? So what does that mean? Whenever we're using this, this is only used for internal management purposes. And this often leads to better decisions. And I'm gonna the textbook says decisions, but I'm gonna say management decisions. So as an example, it shows incremental cost of manufacturing each unit, okay, and operating income will not be affected by changes in inventory levels. All right, so just to kind of review this more carefully, variable costing, only variable manufacturing costs are treated as product costs and only used for internal management purposes. So this is nothing that's going to be done outside the organization. This is just for management to help them make better decisions. And it often leads to better management decision because that fixed element actually gets a little confusing when we're trying to figure out things like pricing and in other areas of decision making. But that's what we're looking at in terms of variable costing. All right. So let's take a look at an example of absorption versus variable costing. There's one of 4 slides, so let's take a look at it. Okay, so we have variable costs. And this is just going to be data or data information that's going to be given to us. So the first step is just looking at data itself. Okay, so from the last point we have fixed MOH 1 million, fixed operating expenses 300,000, and then other information where the units produced is going to be 40,000 units, and the sales price per unit is going to be $100. Okay. Okay, so given that information, we're going to look at the example of absorption versus variable. This is going to be the second part. This is 2 of 2 of 4. We're going to plot out our manufacturing costs per unit. And we're going to look at it from two perspectives. We're going to look at it from absorption and variable costing. Let's go ahead and put that up here. Okay, so we have manufacturing cost per unit, absorption, and variable costs. All right, so first thing we're going to look at is direct materials cost per unit. Well, cost per unit under absorption, well, we know that was actually provided to us. It's $35. That's what we caught in our previous slide. It was $35. Direct materials cost per unit. That plots on both of these. It's going to be $35 for both absorption and variable costing. Direct labor cost per unit. That was also provided. We can go scroll up right here. It was $10. So we'll move that down, and that's going to be the same as well for both absorption and variable costing. So far, no difference. Okay. So now remember that in our previous statement, we're going to break down manufacturing overhead between variable and we also have fixed manufacturing, but we're separating those. So now we're going to look at the variable MOH cost per unit is $5. So variable MOH per unit, and that's going to be $5. But lo and behold, since variable costing says everything that's variable goes into the product cost, so I mean that's the way it is. Absorption says everything, so far it looks to be about the same anyway. All right, but here's where we get our difference. Now we have the fixed MOH cost per unit, and we'll have to compute this. We have a total in our previous slide. Well, yeah, you probably couldn't see that, but fixed MOH cost per unit. In our previous slide, we had $1 million, and that's going to be divided by 40,000 units. So that's going to be $1 million divided by 40,000 units. All right. So here's where the difference holds. Now we can compute this. That's 1 million divided by 40. Where did that come from? Well, we have 1 million MOH. Fixed MOH is 1 million. And the number of units produced were 40,000 units. So we took that 1 million divided by 40,000, and our cost per unit, which does apply, absorption accounts for all of it, so that's 25. But here's the difference. For variable costing, we only take into consideration the variable costs, not the fixed MOH. So that's going to be 0. All right. So now when we look at the total cost per unit, under absorption costing, the total cost is going to be $75. You can run the math, add those up, that's going to be $75. However, for variable costing, the total cost is only going to come up to $50. And the difference is we're going to exclude the fixed manufacturing overhead cost per unit from variable costing. Just as I mentioned in the definition earlier, in variable costing, we're taking only variable costs. We're going to exclude fixed. So to have a comparison, we're looking at absorption, which is what we always known in the past, and then we're going to look at variable costing. This is new. We're excluding the MOH cost per unit. That's now 0. Okay, so the example we're looking at is number 3 of 4. Example absorption versus variable 3 of 4. So now assume the company decides assume the company decides to produce an extra 5,000 units. Variable costing, if we look at variable costing, we're going to take the 5,000 units multiplied by $50 per unit. And that's going to give us $250,000. So if we're trying to know what's this going to really cost if we want another 5,000 units, what's it going to cost us? Well, if we first look at variable costing, we just simply take the variable cost times the number of units, and that's going to come out with 250,000. If we looked at absorption costing, it's going to tell us we'll take the 5,000 units and multiply it by 75. And that's going to be equal to $375,000. But if you think about it, fixed cost by its very nature is saying fixed costs are fixed. They're not going to increase at all. So by including them in the product costs, and essentially the $75 includes that $25 of MOH that's fixed, you've really kind of changed it all up by essentially saying, look, you know, our MOH is going to go up also, but that's inconsistent with the definition of a fixed cost. So under variable cost, we throw out the MOH fixed portion and just focus on the variable cost elements, which gives us a better indication as if we just produce an extra 5,000 units in that one period, how much is going to be our additional cost. So in essence then, variable costing is more accurate for internal decision making. And internal meaning management, right? So if we're trying to decide whether or not we should move forward with this additional 5,000 units, we don't want to use the $75 per unit because the fixed cost is there. As long as we're in that relevant range. Once we cross over that range, then that throws everything up. It makes everything haywire. But as long as we're in the relevant range, we should be able to use just the variable costing as a basis for determining what our total costs are going to be, and then making a decision whether it makes sense to go ahead and move forward, especially if we know we want to give a price break on this because maybe these are volume discounts we're considering. Okay, so if we go on to the fourth step of this, we're looking at taking into consideration the operating expenses as well. So far we've only looked at the product costs, but when we look at taking into consideration the operating expenses, the variable operating expenses when 40,000 units are sold, is going to be 40,000 times $2. I'm sorry, 40,000 units times $2. Okay. And you're saying, well, where did that come from? Where did the two? Well, let's go back to our data point. We're talking about the operating expenses, okay? So the operating expenses way up here, variable operating expense per unit is $2. All right, so that's where we got the $2 from. So variable operating expenses when 40,000 units are sold, 40,000 are sold, that's 40,000 times 2. And under absorption costing, it's going to be $80,000. And the variable costing, it's also going to be $80,000. That's going to be fixed operating expenses. Okay, and that's going to be the same. That's going to be $300,000 for both. All right. So we'll scroll back up, and we notice that the $300,000 is the fix that's given to us as well. All right. And then what we're going to come up with is the fixed MOH, manufacturing overhead. And here's where it gets a little bit different. Remember, because under absorption cost, the fixed MOH was really part of the product cost. We don't break it out from here. This is going to be 0 because it's already been accounted for in the product costs. But for variable costing, remember we excluded the fixed MOH. So now when we're taking into consideration the operating expenses, we're actually gonna drop it right next to the other operating expenses. So we're looking at $1 million. So there's the key, is the difference is under absorption costing, this fixed MOH was really part of the product cost right here. Fixed MOH, boom, right there. But under variable costing, we ignored it. We didn't even take it into consideration. Now, if the cost just doesn't disappear, what it does is it comes down here to, and we're going to include it part of our period costs. Fixed MOH is treated as a period cost. So that's the difference. Now, we took that cost into consideration under the product cost, but since we ignored it for variable costing, we have to put it somewhere. The cost just doesn't go away, right? So now we're going to look at here, we'll look at this in the context of total operating expenses. And for full absorption, it's going to be $380,000, all right? For variable costing, it's going to be $1,380,000. Okay? And again, the difference between absorption and variable is how we treat the fixed manufacturing overhead. Now that we've seen the difference between variable and full absorption, we can now look at the differences between what we refer to as a traditional income statement. And this is what you have seen since you started learning about accounting. Let's say the company is Shredco. This is a traditional income statement, or specifically absorption costing. Okay, and this is for the year ended December 31st. First sales revenue, which is going to be 40,000 units multiplied by $100 per unit. I think that was given, the sales price. Under other information, was that given for us? Sales price per unit, $100, yeah. Okay. So now we're going to put together an income statement based upon the two methods. This is the traditional, this is the full absorption method, so that the total amount of sales revenue is going to be $4 million. Less cost of goods sold, which will be 40,000 times $75. Remember, the $75 is the cost of you. That's the full absorption guide. That includes variable and fixed costs, including the MOH. Remember the 75? That's what we came up with. So that turns out to be $3 million. And so then our gross profit is simply going to be the 4 million minus the 3 million. So our gross profit is going to be $1 million, right? And then we can then take less operating expenses. And we're talking about $300,000 plus the variable portion of operating expenses, which was 40,000 units times $2. Right? You remember that? And that gives us $380,000. And so from there we can compute operating income. We take our gross profit and subtract our operating expenses, and we come up with $620,000. So we'll go ahead and fill in the gaps here. Okay, so this is what you would expect to see with a traditional income statement. And you'll see that the income is showing to be $620,000. And that's based on 40,000 units, right? Here's our contribution margin income statement. We're looking at the sales, what we talked about, $4 million, less variable expenses, which include variable cost of goods sold at $50. That's the $2 million extension. Variable operating expenses, $40,000 times $2. You should remember that that's what we had come up with before, so that's $80,000. And now, rather than gross profit, we're coming up with what's referred to as contribution margin. Contribution margin is simply taking your sales revenue minus your variable costs. So that gives you your contribution margin. And then we're going to subtract our fixed costs. And if you recall, our fixed costs are fixed manufacturing overhead, $1 million, and fixed operating expenses, $300,000. And the total operating income is $620,000. Now, if you recall, this operating income, $620,000, is the same as what we came up with the traditional income statement. But the presentation is different, right? The presentation is different because now we're breaking our costs up between variable and fixed, right? This helps management a little bit better now, understanding what every incremental or every additional unit is going to cost by breaking it up between variable and fixed. At least it's going to give us a better feel for it, right? Because we know that now every unit that's cost, if in terms of variable costs, they will go up, but our fixed will be fixed, so we won't have to worry about adding those costs, which might help us with pricing if we have volume discounts. We're figuring that our overall costs will go down with volumes, so we're able to give a better pricing scheme or give a better pricing offer to customers who buy in volume. Okay, so that's what our contribution margin income statement would look like. Okay, so we can talk a little bit about what's referred to as the contribution margin income statement characteristics. The contribution margin income statement characteristics. Okay, so first of all, the contribution margin income statement is organized by cost behavior, which means we're breaking down our costs or classifying our costs as either fixed or variable. All variable costs are expensed above the contribution margin line. So variable costs go above the contribution margin line. If we're going to go back and look, here's the contribution margin, your variable costs are all above it. Okay, so that's what we mean by the variable costs are above the contribution line. Correspondingly, all fixed costs are expensed below the contribution margin line. So this could be obvious, this should be obvious, but we have the contribution line right here. Variable costs are on top, and then fixed costs are below. All right, so that's what we mean by all fixed costs are expensed below the contribution margin line. Contribution margin is computed by taking the sales revenue minus the variable expenses. Okay, which we demonstrated you before. Operating income is the same in both statements when all units are produced and sold in the same period. All right. Now this can get a little confusing, but in essence what we're saying is that our inventory levels, whatever we have in inventory, it doesn't change from the beginning to the ending of the period. They remain the same, and that's what we mean by all the units that are produced are sold. All right, inventory levels didn't change. They started off as 100. We produced a whole bunch. We sold a whole bunch. And we ended up with 100. So we sold everything we received. And in that situation, or in that case, the income, the operating income for both the contribution margin and full absorption are going to be the same. Service and merchandising. Merchandising companies operating income will always be the same regardless, will always be the same regardless of format. And again, as like we've mentioned before, only for internal use. You would not produce a contribution margin statement and distribute it out along with your traditional income statement, or instead of. No, that wouldn't happen. You would use the traditional financial statement that you learned in Accounting 1. That's all for external use. This contribution margin income statement is only for internal use. Okay, taking a look at service and merchandising companies. And this will be 2 slides that we're going to be looking at. So don't have MOH, meaning variable and absorption costing do not or do not apply differently. Let's look at an example here. WSC Consulting, contribution margin income statement. For the year ending December 31st, we'll have our sales revenue. As an example, it's $160,000. All right, and we'll have less variable expenses. Which in this case would be $2,500. In this example, it would be $2,500. And we compute the contribution margin similar to what we've seen before. And that contribution margin is $160,000 less the $2,500, so in essence we have $157,500, and then less fixed expenses. Fixed expenses, and those fixed expenses in this case are going to be $127,500, and then so therefore our operating income is contribution margin minus your fixed expenses, which is $30,000. So this would be a typical contribution margin income statement for a service company, and you'll leave out elements that you had for the merchandising company, including the cost of goods sold.